Good morning and welcome, dear friends, to the CEC live lecture session. In today's ongoing session, we are taking a series that is Behavioral Finance. And in this series, today's topic is Heuristics and Biases Part 2. To discuss this topic with us in studios, we have Dr. Divya Verma. Dr. Verma is an assistant professor in School of Management Studies, GGS IPU. Dear friends, before starting this lecture, let me remind you that if you have any questions and queries regarding this ongoing session, you can call us on our toll-free number. So, our toll-free number is 1800-110-430. So, let's start the topic and welcome Dr. Divya Verma to the studios. Welcome to the studios, ma'am, and please continue.
Thank you, Dr. Seema. Friends, continuing with the topic of heuristics and biases. Till now we have talked about that the behavioral finance is one upcoming area of finance where we are interested in looking at how investors, what is their behavior and how the behavior of investor is going to impact their investment decisions. So, very largely the behavior of the investor is dependent upon their attitude and their the heuristics and biases which they are affected by, which are formed over years as with their growth as a person. And so there are certain habits which we are continuously performing, which leads to forming some sort of rule of thumbs for us, or some heuristics which we try to implement as and when a quick decision has to be taken. And some of our habits or attitude form a part of that subconscious actions or decisions which we take, which somehow are taken mistakenly, so they are termed as biases. So these biases are of two types, as we discussed in the previous lecture on heuristics and biases. These are cognitive biases and emotional biases. Cognitive biases are related to human mind, the way people process information, interpret information around them and develop their logic. These biases become rule of thumb and helps the decision making, which can be wrong also. So these biases are somewhat related to memory, and these can be learned, and once you understand that there is a particular bias which someone is affected by, so you can work upon it so that you are not affected by it while taking some important investment decisions in life. Second type of bias is an emotional bias. Now, emotional biases are little more difficult to handle. All human beings are full of emotions and we are affected by one or the other bias. So, clear understanding of these biases and their impact can help investors minimize the impact on the decision making. Taking it further, so in the last lecture we had discussed about overconfidence bias and cognitive dissonance bias. Today we will start with the self-attribution bias. Self-attribution bias basically is that tendency of human being where we try to attribute the cause of our success or failure on something else. So like humans have this tendency that whenever they are successful, so they would assign all the success to their skills and knowledge which they have gained throughout the life, and all failures are attributed to the bad luck. So failures are attributed to all external factors, that because government was not supportive, or my office was not supportive, or something else happened, or the stock market was going down, because of which we have incurred the losses, or the decision was not correct. So somehow this bias is particularly used as a means of self-protection, and this bias can ultimately lead to overconfidence in the personalities of people. For example, if a student who is performing well in exam, he can give credit to their hard work, that if they perform well, they will say that I was successful because I studied hard. But if somebody fails in an exam, so they can blame the grading system, or they can blame their teachers, or they can blame the question paper that it was not right, because of which we failed the exam or we could score less. So this bias has two components. One is self-enhancing bias and self-protecting bias. Self-enhancing bias represents a person's ability to claim huge credit for their success to themselves. Self-protecting bias is shifting the burden of failure on bad luck or some external factors. Now, how this bias is going to affect the investors while taking investment decision? if somebody does not attribute the reason of failure to themselves, so they will not learn from their mistakes. So if somebody is putting the blame of their failure to someone else, so they will not have this lesson of learning from their mistakes and improving upon themselves. And attributing credit of their success to oneself makes an investor overconfident. So in that way, he is able to ignore all the reasons why something has happened, or he is successful or he is unsuccessful. So if somebody gets less or negative returns on their portfolio, then it will cause less dissatisfaction if he can transfer the burden onto his financial advisor or the market scenario rather than on oneself. During bullish trend in the market, if an investor earns good return and is affected by self-attribution bias, so he will give all the credit of his success to himself and will become overconfident, and later on when the markets are more volatile, he can be at risk or he can incur losses, then he will not be able to understand that why he has incurred the losses. So this particular bias can bring more than recommended trading by the investors because they become overconfident and then pose them to a higher risk. So in this bias, investors hear what they want to hear. They can hold less diversified portfolio, which ultimately increases their risk, so is not very recommended. And if you understand that you are suffering from this particular bias, that you are ignoring your success or you are taking your success to yourself and putting the blame of your failures on others, then you must be careful about whenever you are taking some important strategic decisions related to investment, because it can be a reason why you have become overconfident as an investor, or you need to be careful when the markets are at losses, or if your investments are not giving you the right returns. Second bias is illusion of control bias. Illusion of control is again a cognitive bias where people overestimate their ability to control an event, and they assume that the outcome in any situation is totally in their control. So illusion of control is a kind of feeling that a person feels that he is in charge of everything, and he feels that he is the one who is controlling all the situation and scenario at a given point of time. So when people have such type of bias, there are chances that they become overconfident and they feel that they will never be unsuccessful because they are the one who are controlling the situation, but it actually doesn't happen. Eileen Langer, PhD of Harvard University Psychology Department, has defined illusion of control bias as the expectancy of a personal success probability inappropriately higher than the objective probability would warrant. Langer established that task familiarity, choice, competition, active involvement can inflate somebody's confidence and generate illusion of control. Usually this illusion of control is common where the person knows the desired outcome and the situation is familiar to them. So if you are doing a repetitive task, so once you have successfully done it once, another time when you are given a chance to do it again, so you feel you tend to get into an illusion of control bias, because you may feel that you understand what will be the outcome and you are familiar to the situation, so things are in your control. But usually in life we have seen that nothing is in the control of one person. Even the investment in the stock market is not in the control of one single person. There are macroeconomic factors which are affecting your investments and returns and the prices. So nobody is in control of all the situations in life. So this particular bias makes you overconfident and can lead to taking wrong decisions or increasing your risk. So when a person gets feedback on his success, this can increase this particular bias, and in case he gets a feedback of failure, this will reduce this bias. So illusion of control increases in stressful and competitive environment, and when people have emotional needs to control the outcome. For example, in case a person purchases a lottery, so he feels that if he is allowed to choose a lottery, he is buying, then his chances to win increases as compared to when the seller is issuing him a random lottery number. Although there is no significant relationship between if you choose a lottery or somebody else gives it to you and your chances of winning, but if this kind of impression is taken by you, that means there is some sort of illusion of control which you are carrying. A person believes that if he buys the stock of those companies where he has some control, then he will assume that those stocks will give higher returns, which may not be the case. The implication of this particular bias on investments can be that if an investor is affected by this bias, he tends to believe that he possesses more control over the outcome than they actually do. So this can ultimately result in overtrading and thus can reduce their return and also can increase their risk. The control that investors have on their investment is illusionary. So an investor may concentrate his portfolio to few companies and have higher risk because of less diversified portfolio. To have excess control over investments, these investors use limit orders which make them miss overlooked opportunities. Third type of bias is conservatism bias. Conservatism bias is again a cognitive bias. That means it's related to our memory and our logical thinking and processes, in which a person does not possess new information and use only basic old information to take their decisions. So their previous knowledge, belief, perception about any event or product or situation will be given more weightage as compared to any new information or evidence on the subject. People who are conservative by attitude, so they are ready to take less risk in life and they are not even ready to absorb new information which comes to them. So whatever new information will come, they will ignore that information while taking any of the decisions which they have to take. And this can lead to reaching them into losses or increasing their risk profile because of ignoring the recent information or any substantial information which can affect their investments. It leads to investors underreacting to new information. So people who are affected by a conservatism bias, they underreact to new information which comes or ignore that information, and maintaining a perception derived from the previous old information or their past experiences. In representativeness bias, investors overreact to new information, while in conservatism bias, investors underreact to new information. Even if a conservative bias trader reacts to the new information, his reaction will be too slow to the new information, which will reduce the meaning or which will reduce the impact of the information on that decision. It has been observed by wealth managers that many clients do not rationally adjust and act to new information as they are sticking to their previous belief system. If in a family one has burned their fingers in the stock market crashes for many years, for next few generations they will only have a wrong perception about the market and will not invest in this market. Even though new economic and market environment changes support safe investments in the market, but such investor families may not give any weightage to new information, so that means they are suffering from conservatism bias. We have seen this bias in elderly people also. Elderly people in the family usually have some conservatism bias as they have certain beliefs in mind to convince them with the new belief system and becomes a challenge for the young generation. That's what sometimes we name it as generation gap. An investor can purchase a stock of a company who announces a merger with another company. Now investor is optimistic about it and he buys the stock. Later on, the merger does not happen and the deal gets cancelled, and there can be some negative news about the company. Now an investor who is affected by conservatism bias can ignore the new news about the company and will carry out that optimistic impression about the company and can end up losing his money in the market. Now implications of this bias on investors includes that it can make the investor non-responsive to any new information which comes, and they can remain invested in the wrong type of stocks and not disinvesting as and when the market expects them to disinvest, and thus they can lead to less returns or can even incur losses. These investors can react too slowly to any new information which comes. When earning announcements leads to negative returns on a stock, such investors can become slow and earn losses. There can be a difficulty for these investors to process new information, thus they miss opportunities to earn better returns. Next bias is ambiguity aversion bias. Ambiguity aversion is also known as uncertainty aversion. It is a cognitive bias where individuals prefer for known risk over the unknown or uncertain risk. Such an individual would choose an alternative where probability of outcome is known as compared to when such probabilities are not known to them. Another aspect of ambiguity aversion is competence effect. The investor who feels that they are more knowledgeable in making financial decisions are more willing to act on their judgment and are not affected by ambiguity aversion. Such investors can expect high returns for taking the perceived risk in their investments. Now, examples of these type of investors can be that these investors may buy local stocks as they are more familiar as compared to the foreign stocks. Such investors may give more preference to their own employer stocks like ESOPs as compared to the stocks of unfamiliar firms. Implications for such investors: this particular bias can lead to the problem of insufficient diversification, and when the diversification is not sufficient, we all understand that the returns will not be maximized and the risk can also be higher. Because of competency effect, there are two behaviors of investors, namely trading frequency and home bias. As per trading frequency, investors who feel more competent happen to trade, and home bias refers to that tendency to overweight domestic equities and underweight international equities in their investment portfolios. Another bias we are going to discuss today is endowment bias. Endowment bias is an emotional bias. This bias relates to when a person overvalues an asset which is owned by them than its market value as compared to those assets which he does not own. It can be seen when people are not ready to exchange an item which they possess in exchange of some cash. So, very common example which we have seen even in small kids around us, or even youngsters, or everyone around us can have this particular bias. We have seen small kids, if they are possessing a particular toy and if you ask them that, exchange this toy with something else, something better, they will not be ready to exchange, because they feel that the toy which they are carrying is much more valuable to them as compared to what you are offering to them in exchange. We have seen this particular bias in women also. When you ask a woman, they are very possessive about their jewelry. So if you ask them to, sell the jewelry which they have got as a gift from their parents during their marriage in exchange of some cash or in exchange of some other jewelry, they may be little bit, not ready to do that, because that's because of the endowment bias, because they have certain sentimental value attached to the jewelry which was gifted by their parents. So this bias is, most of us are affected by this. So once a person owns a particular thing, then they assume that its value is more than what they do not possess. It can be relevant to those items who have symbolic value, experiential value, or emotional significance. And this bias is more prominent with inherited assets, owned assets, and assets where we have a desire of familiarity. Now, endowment bias is an illustration of status quo bias, and it can also be explained by the loss aversion concept, that we do not want to change the status quo. Whatever we are possessing, whatever assets we have today, we don't want to exchange it with anything else. Now, endowment bias leads to holding of security for very long by the investors. So some people you have seen, they are not ready to sell their old houses or sell their old investments, real estate investment, or their old shares which they are possessing, just because of this endowment bias, because the kind of value they attach to it is much more larger than what is being offered to them in the market price. Now, the behavior of holding own securities is because of the decision paralysis when they place an irrational price for an exchange of an endowment assets. So many females hold assets or gold given by their parents even if the designs are not wearable. Many people are emotionally attached to their ancestral property and do not sell it even if nobody is going to use them. An artist would price his created art pieces highly costly as compared to the value art pieces which some other artist has designed. Now, how this particular bias can affect the investment decision making? This bias leads to investors holding their securities which they have inherited from their ancestors. Even if it is not profitable, they would not like to sell it because of that endowment feeling or that inherited feeling which they have, and this can affect their diversification, this can affect their risk attitude, this can affect their losses which they have to incur. Investor is holding endowed security as they may not be interested in incurring transaction cost on these securities, even though that cost is very small. Next bias we are going to discuss is self-control bias. Self-control is a very important attitude feature which each one of us possess and each one of us should practice. Self-control means an ability to override our urges. Self-control bias is an emotional bias which forms human behavior when people are not able to control their urge to save for tomorrow from investment perspective. Self-control bias is a gap between people's desire and their ability to act sincerely in fulfilling those desires because of lack of self-discipline. We forego our future plans for fulfilling our current desires to achieve temporary satisfaction. If two similar rewards are available, people give more weightage to the one which arrives early rather than late, as they discount the value of the later reward because of the length of delay, which is known as hyperbolic discounting. For example, a student who wants to get good marks in a test tomorrow should study today. But if there is a party which is going to be held today with his friends, so to achieve his goal, he should miss the party. But for the immediate satisfaction, and in case he is not having good self-control, then he would attend the party and ultimately would affect his scores in the exam. An overweight person who is on dieting should decline any temptation of pastry or chocolate or ice cream. But if he is not able to have a self-control and accept that particular offer of eating a chocolate or a ice cream, then that means he is affected by self-control bias. A person may not save for retirement and spend all the money today on unnecessary expenditure or on entertainment rather than saving for tomorrow. So all of these are examples of lack of self-control. Otherwise, self-control is a very important habit or a very important thing which each one of us should practice, especially with the small kids, and each one of us at any stage of life should have good amount of self-control, because having higher self-control makes us more successful in life. We are able to handle a lot of situations in our life in a much better way if we have good amount of self-control rather than having a lack of self-control. So similarly, self-control bias or having lack of self-control also affects the investments in their investment decisions. Investors tend to spend more today as compared to save for tomorrow. So if they'll have less savings, they will invest less, they'll have less of the investment returns. Now, self-control bias can also link to asset allocation imbalance problems. So people can prefer to regular income producing assets rather than future capital gain assets. So now talking about optimism bias. Now, optimism bias is also known as unrealistic or comparative optimism. It is also an emotional bias. Now, till now we are talking about a mix of cognitive and emotional biases. Cognitive biases are affecting us based on all the news and information and the logical reasoning and our memory and our decisions which we are taking. And we can easily, if we understand that there is a particular bias which we can be affected by while taking any decision, we can try to work upon it and try to see that we are not affected by it while the decision has to be taken, and then we can take a right decision at the right time. Rest of the things we will continue later.
Thank you, ma'am. Dear friends, here we come to a short break of this session. We'll be continuing after the break, but before going to break, let me remind you that if you have any questions regarding this ongoing session, you can call us on our toll-free number in the last 10 minutes of this lecture. And for that, please write down our toll-free number, that is 1800-110-430. We'll be right back after a really short break. Stay tuned. Welcome back, friends. Today we are discussing the topic Heuristics and Biases Part 2. Let's start with this topic. Ma'am, please continue.
So friends, we were talking about various cognitive and emotional biases. Taking it further, we'll discuss about optimism bias. Optimism bias is also known as unrealistic or comparative optimism. It is an emotional bias. It is a common bias which can affect us irrespective of our age, gender, race. Under this bias, individuals tend to believe that they will not experience any negative impact as compared to others. So, optimism otherwise is a good quality which each one of us should possess, that we should look at things very positively and optimistically. But sometimes if we are overburdened with this bias and we are over affected by this optimism bias, it can lead us to a lot of problems in terms of our decision making, where we ignore all of the negative factors and we only take our decision assuming that everything in the life is going to be very good with me. So there exist 4 factors that can cause an individual to be optimistically biased: their desired end state, their cognitive mechanism, the information they have about themselves versus others, and their overall mood. So all of these 4 things can at any time play a role and can lead us to be optimistically biased. Optimism bias can happen for both positive events and negative events. Positive events bring feeling of self-esteem and negative events bring high exposure to risk. The impact of this bias is stronger for negative impact. For example, a person who smokes, he would always believe that he will not get lung cancer or any other disease because of smoking, because otherwise each one of us understand and listen to that what things smoking can harm, smoking can do to our body, but as a person we may believe that we will not get it. So that is over optimism, that is optimism bias we are affected by. Bungee jumpers, they can assume that they will never get an injury. One can assume that himself to be an above average investor, that whenever I will invest money in the stock market, I will always earn profit. If that is the kind of feeling you have in your mind, that means there is an optimism bias which you are suffering by. An investor can have an impression that he will never incur any losses. So having that kind of such a highly positive attitude towards and overestimating your ability that you will never have losses can lead you to lot of problems and losses in practically in life. Now, implications for investors can be that due to optimism bias, an investor can buy more of one company's stock where they are associated, as they feel that we are working in this company, so this company is less risky and our returns will also be maximized. Optimism bias can lead investors to ignore inflation, taxes, compounding effect, and can make them assume that they are getting high returns rather than looking at the overall scenario of the market. They tend to have more favorable forecast and not only look at the rosy reports. They assume that they will never have losses as they are above average in every aspect of life. Optimism bias can also lead to home bias in investors. Next important bias is mental accounting bias. Again, this is something very common and popular in which we can see in our routine life. Richard Thaler propounded the mental accounting concept. He got Nobel Prize in 2017 for his contribution in behavioral economics. Mental accounting is a cognitive bias. Mental accounting is a process where individuals categorize their financial decisions into mental accounts. They tend to or in which they head or evaluate them from time to time, but these heads are not interchangeable. So what happens in mental accounting related to investment, that we try to allocate things in different compartments or in different heads or accounts, and we try to put our money or our expenditure into that account, and we try to see that those accounts are not interchangeable. So this categorization may not be always rationally done, and it can be based on some subjective criteria like sources of money, income account, expense account, wealth account. So these can affect us at any point of time. So the money segregated for one account is somehow not used by us or transferred to other accounts. So Kahneman and Tversky in 1984 conducted a research study on it. So let's assume, so they conducted a study wherein that they assume that a person buys a movie ticket, let's say for rupees 200, and he goes to the theatre. When you enter the theatre, that person realizes that the ticket is lost on the way. Now, would he spend rupees 200 to buy a new ticket and watch movie? So, this survey was conducted and it was found that 46% people are ready to buy another ticket and watch movie, but 54% answered no, they will not buy another ticket. The reason is that one has allocated rupees 200 in their mental account for watching movie. Now, if this movie is going to cost you rupees 400, so one feels that watching this particular movie is getting costly for you. So, majority of people will not like to watch this movie. But there can be a second scenario. Let's say it was told to you that you go to the movie theatre and buy a ticket at that time. So, you are carrying some cash in your pocket and you go to the movie hall. Then you realize that as you try to take out 200 rupees note from your pocket, you realize that your pocket is empty and the 200 rupee note is lost. So, now would you like to watch a movie or not? So, again this survey was given to people and 88% people said yes, we will buy a ticket, we will take out money from ATM or use some other money which is there with us and buy a movie ticket. But 12% said no. Now, how come there was this change in the reaction, although the movie ticket was for the same 200 rupees and there was either buying one ticket or carrying cash and buying a ticket with that? So, the reason is, although that rupees 200 loss you have incurred, but that was not kept for the mental account for watching movie. So, one is conveniently ready for spending rupees 200 more for watching the movie. The total outflow in both the scenario is rupees 400, but the difference is of mental account under which the money was spent. So, we have seen in many families that people try to do mental account of their expenditure, that this is the amount of money they spend on buying vegetables or on daily grocery or on petrol or on mobile expenses, and like this on education, on medical expenses and all that. So, once we try to put in money in such type of different baskets or compartmentalize these accounts, then in case let's say inflation increases or prices rise for one particular commodity, we try to adjust ourselves within that same budget of grocery or within that same budget of education expenses or whatever entertainment expenses we are making. So, if that is the scenario which you are doing, that means there is a mental accounting bias, because your total fund actually is going to remain the same. So, total expenditure is going to remain the same, but you should be comfortable enough to transfer money from one expense to another expense. But if it does not happen, that means there is mental accounting bias which can take you to any type of decisions which you are taking in life. Now, what are the implications for investor of this particular bias? Based on mental accounting, people put their money in separate accounts, but while designing a portfolio for their overall investment objective, they may end up getting less than optimum performance because of not able to correlate across mental accounts. Many a times, investors try to preserve capital and plan to spend interest. So, investors may plan to irrationally keep income and capital appreciation separately in different mental accounts. This can ultimately erode their principal due to interest rate fluctuations or any other reason. So, many of the times we have seen that people are putting their investments also in a way that this money would only go to stock market, this money will only go to fixed deposit, this money will only go to, and this is how they compartmentalize or design their portfolio, and they are not ready to change their portfolio. So, if such type of scenario happens, then they may lose on their return on investment, where sometimes one particular investment avenue becomes more profitable as compared to the another one. So, one should be flexible enough to change their investment portfolio in case they are not affected by mental accounting. So, mental accounting bias makes investors not to look at their total income and investment in totality, which makes them difficult to diversify and reduce their overall risk. For example, there are people who got ESOPs, employee stock option plans, and do not count them in their investment portfolio, and thus increase their overall risk of equity investment. Next, we are going to talk about confirmation bias. Confirmation bias is a cognitive bias. also known as confirmatory bias or my side bias. It is a type of selective perception wherein a person emphasizes on those information which confirms their belief and devalue whatever contradicts their thought. So that means whatever is our mindset or whatever we know by our experience, whatever belief system we have decided for ourselves, whatever new information we get, we try to receive only that information which conforms with our existing belief system. Whatever we know by our earlier experiences, whatever is our habits, whatever we understand, whatever knowledge we have, we try to look at any new information from that perspective and ignore whatever does not conform to our thought processes. It is a tendency to search, interpret or recall all information in such a way that confirms one's pre-existing beliefs or give less consideration to other alternatives, and this is also one kind of selection bias. Let's say you have purchased a car and then you try to confirm it to your friends and family by looking at various information you come across, justifying your purchase and justifying it to them that why this particular color which I have purchased is the best, how you have got the best price, why it was the best brand, why it is the best performing and having the good mileage. So all these things you try to confirm to everybody else, even if you receive some information of a better brand, of a better price, of a better a performance car which is again competitively priced, which you listen to or you read about. So you try to ignore all those facts and try to conform to whatever you possess or whatever you know about it. So implication of this particular bias related to investment decision making can be in the form that selective perception of information about any company can lead to wrong selection of stocks and holding wrong portfolio as trends and performance of companies keep on changing. So once you have made an opinion about, let's say, a particular company, a particular brand, and then whatever new information comes about them, if you try to ignore all that new information related to the performance of the company, that means you are affected by the confirmation bias. So to earn good returns from the market, investors should take decisions to change their portfolio based on the trends in the market. This bias can cause employees to overinvest in company stock. Due to this bias, investors may hold less diversified portfolio, leading to low returns. Hindsight bias. Hindsight bias is a cognitive bias where people tend to perceive that they had predicted this event. Now, many of us very commonly found out a bias that I knew it attitude. So there are people who have this, word very frequently used by them, that I knew it. It is a tendency of individual to falsely believe that they predicted this particular event. This bias affects the future forecasting, and because of this bias, one does not learn from their mistake. Having hindsight bias can be really destructive, as investors feel that they can predict the market very well. So whatever happens, they would say that, I knew it beforehand that it is going to happen. For example, when a stock market bubble bursts, so many people would say that I knew that it was a bubble. How it is going to affect your decision making as an investor? Hindsight bias investors write their own memories and portray that they had predicted the event, so this can lead to excessive risk taking attitude by them. Hindsight biased investors put blame of poor performance on their investment advisors or unduly praise them when they earn profit for them. Next bias is recency bias. Recency bias is again a cognitive bias where which makes people recall the most recent event, object or action as compared to those that happened in the past, and based on that they make their judgment or decisions. So whatever comes to our mind most recently, we remember that and we take our decision based on that recently happened event or recently received information, and ignoring all the past information, all the past decisions and performance related things which you had in your mind. So one can remember what happens most recently, which can be positive or negative, based on which a person can evaluate an event as a positive or negative. Suppose a person who is coming across various news in the newspaper related to positive and negative opinion on recent government policies like demonetization, GST, and happen to read most recent news related to positive impact of the government policy, how these people and how people have welcomed these policies, he may make an opinion that public is favoring new policies. And if that's how you make your decision, or that's how you take your talk about things, so that means there is recency bias which exists. Now, recency bias can be a bias which can affect your investment decision, can affect your daily purchase decision, and if you understand, marketers use it very well. All the companies who are doing marketing through advertisements of their products, so they are all working on this recency bias which each of us is affected by, because recency bias would make us purchase things which we recently remember. So, if you are regularly watching some advertisement, so you will carry a positive impression about that particular product, and next time when you go to a grocery store, it may happen that you end up buying that particular product, and that is because of recency bias. So, that is why all the marketers, they are always fighting towards having the best TRP ad which they can show at the right time where there are maximum viewers, and repeating their ads number of times, just because people have a memory and people will recall the ad next time whenever they are going to market to buy anything. So, recency bias can affect the investor decision making as well. Recency bias can lead to making projections based on small historical sample, which can lead to purchasing stocks at peak prices or end up experiencing losses. Recency bias make investor to ignore fundamental value and focus on recent price performance or news about the company. Next bias is regret aversion bias. Regret aversion bias is an emotional bias wherein an investor seeks to forestall the pain of regret associated with poor decision making. Individuals avoid any decisions because they fear that they may have to regret later, as a result may not be optimal. So, shareholders may keep on holding their position for very long to avoid any errors and regret aversion. So, it can come following any losses or even gains also. People with this bias commit two types of mistakes. One is error of commission and error of omission. Error of commission which occurs when they take misguided actions, and error of omission, these arise from misguided inaction, that some opportunities get missed or foregone. So, because of this bias, an investor can become either risk averse or risk taker. An investor buys a stock on financial advisor's suggestion, and later on the price fall, an investor incurs a loss, and then he is regretting. So, to avoid any regret in future, he will not follow his friend blindly, or he will not follow his investment advisor blindly, and he will do his own research before investing. Alternatively, assume that he has not agreed to investors' recommendation and did not buy the stock and the price increases. So, in future the investor will always follow the advisor's recommendation to avoid any situation of regret. So, in our routine decisions, in our routine lives, we have this particular tendency of avoiding the regret, so that we do not end up regretting that we could not do it or we have done it wrongly. So, we try to be regret averse, because of which there can be a situation of we being less risk takers, or we being loss averse as an investor. So, many of the investors, they try to remain at the status quo level. You do not want to change your decision, or you want to make things as it is and maintain that status quo, so that you do not have regret later, and you want to avoid that regret, because of which you have an attitude of risk aversion or loss aversion, and makes you a conservative investor as well. Implication for investment decision of regret aversion bias can be that regret aversion can make investors to be conservative in their investment choices if they have suffered losses in the past. So, if you have faced losses once, then maybe to avoid that regret later on, you become conservative and you do not want to take any risk, or you do not want to change your portfolio. Regret aversion can lead to holding on to stock positions for very long time by investors. it can cause herding behavior also, because sometimes you are not confident enough that I may regret it later. So you don't want to regret anything, any decision which you have taken. So what you do, you try to follow the others. So whatever others are doing, whatever your friends are doing, your family is doing, your peers are doing, you try to follow them. You try to follow whatever other investors are doing in the market, and that also again causes you earning less returns, or not managing your portfolio efficiently. So regret aversion leads investors to prefer stocks which are popularly known as good companies and will end up getting normal returns. Regret aversion can lead to holding on winning stock for too long by the investors. Another one is status quo bias. Status quo bias was the term given by William Samuelson and Richard Zeckhauser in 1988 as an emotional bias. It is a bias in which people tend to ignore or not choose any alternative but try to maintain their existing condition, that is the status quo, as any new option can bring changes. So this principle of inertia states that a body at rest shall remain at rest until acted by some outside forces. So people always say things have always been like this, so they try to continue it in the same way. That means that means there is a status quo bias which they are affected by. So investors with inherited stocks, with inherited property, can exhibit classic status quo bias. For example, a grandson may hesitate to sell the stock which he has got from inheritance from his grandfather, even though his portfolio is under diversified. The change will bring him higher returns, but he still wants to maintain the status quo because he do not want to get into that regret aversion stage, or want to avoid the cost, or has some endowment attached to it. Because of various reasons, he doesn't want to move the portfolio from here and there. So the reason may be that he is not understanding the risk related to holding equity share. Secondly, he may be having some personal attachment, or there are transaction costs and taxes involved. Now, implications for investors for this particular bias can be that investor may not change their portfolio and might end up taking high risk or become very conservative. Status quo bias can operate because of familiarity or emotional attachment. So investors may hold some securities for which they may get poor returns. Inheritance of financial assets or endowment bias can also lead to status quo bias for investors. Status quo bias can be seen in a combination of loss aversion, as investors may also hold their position and they don't want to incur the losses. Another important bias which we have come across many times is framing bias. Framing bias is a cognitive bias that takes into consideration the context in which a choice is presented or framed as a basis of taking decisions. Like various shops you have seen would put up a board that there is a mid-season sale going on or on off-season sale going on, and there is flat 50% offer, and in bigger font, and on a very small font it will be written that with a star mark, conditions apply, or you will get 50% if you buy 5 articles. And people, so that's one way of attracting people to their store or their shop, so that they come and see and end up buying some articles. So this is because of the framing effect, that we try to frame things in such a way that whatever we want as a marketer, whatever we want the decision to happen, we convince the investor or the consumer to buy those things. So there is a phenomena called narrow framing, which occurs when people see very narrow and focus only on one or two aspects of the situation, excluding crucial aspect, and thus making a compromise in their decisions. An individual's willingness to accept risk can be influenced by how situations are framed to him, positively or negatively. So sometimes and very beautifully we can see the effect of framing in terms of advertisement, which various marketers would show up for launching their products, for telling about the benefits, or negative about other people's product. So the way things are framed in an advertisement, the kind of self-image they try to portray, or the kind of things which they try to show, that if you will have this particular cold drink, then this will increase your self-esteem, or this is what winners would drink, and such kind of positive words which they will use. So it is going in our subconscious mind and will end up making us take a decision that these things are good, and if we want to feel self-confident, or if when we are successful or when we are in a party mode, we should drink this particular thing. So that's how things are framed. And we have also seen the framing effect in our routine lives. We have seen our kids, or we have seen our subordinates in our offices. If they want, the way you would go to your boss and request for a leave. So the way you would frame the things can change his decision in terms of whether he will give you a leave or not, or the way you want your decision to be presented, your project to be presented to your boss, in terms of whether he'll accept it or not. So the way you present it is very, very important. That is what framing is all about. So kids know how to frame a request to their parents to attend a party so that they do not refuse. Similarly, an investment advisor can talk about gains first and probability of losses later, and may be able to sell a mutual fund as compared to those who to other advisors who are not able to convince their client with the same proposal because of talking about some risks more. So we have always seen that we get some phone calls that you have to, if you want a credit card, or if you want to take up a personal loan or something like that, or you want to buy some insurance or a mutual fund. So sometimes we are convinced with a person who is talking to us just because the way he has presented the things, as compared to some of the calls which we simply ignore and we don't want to even listen to those people. So that means one needs to learn, the marketers need to learn the art of how you have to convince your client, how you will present the things, so that whatever you want as an answer or as an outcome, you get it by the way things are framed by you. It depends on how questions are framed. Investor risk tolerance can either be conservative or aggressive. The implication of this bias for the investors can be that if investment advice is framed using optimistic words, phrases, or context, they will get affirmative response of investors, and the reverse can also be true. So framing affects the judgment of investors. Framing and loss aversion both explain excessive risk aversion. An investor who chooses risky investment may incur losses as compared to those investors who have chooses less risky investment. Now, what are the strategies to overcome these biases? Related to investment in stock, when an investor wants to invest in stock market, they should know their objective, time horizon of investment. He must calculate their risk and expected return. Also, they should have some specific investment strategy like value investing, reshuffle their portfolio from time to time, so that these biases get adjusted. When you are investing in mutual funds, as an investor is putting in their money, one should look at the operating cost of fund or the expense ratio. It should be low, and also look at the historical performance of the fund. You should ignore the rule of thumbs, because whenever there are rule of thumbs which you are following for taking any type of decision, so in that case this can affect you in terms of you are affected by certain bias. Framing bias and optimism bias should be taken care of while taking any type of decision. That's all about the heuristics and biases, and in a way investor can always take care of these particular biases, and proper understanding of these biases will make you more aware and will end you up not getting into these traps and not making mistakes in investments. Thank you so much.
Thank you, ma'am. Thank you for this very informative lecture of yours. Dear friends, I am sure that this lecture must have added to your knowledge. We at CEC are always ready with such educational and informative lectures for you. So stay tuned with us. Thank you.